Good afternoon, everybody. This is Brian Hartman coming to you live from Pharus Global headquarters in Pharus Global Plaza, Port St. Lucie, Florida. We're at 1859 Southeast Port St. Lucie Boulevard in Port St. Lucie. And I am very excited to have back on the show today our favorite mortgage singing guy, or singing mortgage guy, I should say. Mr. Frank Lillo is going to be with us today. We are at Pharus Global. We do everything from bookkeeping, financial management, marketing services, HR services. We do exit planning strategy, insurance. We do commercial mortgages. We do home mortgages, which Frank is going to talk about today. We do IT services. We have practice management, billing, coding, credentialing for medical practices and dental practices. We do residential and commercial real estate and a whole slew of other things. You can see everything we do at pharusglobal.com. We are, as I mentioned, at 1859 Southeast Port St. Lucie Boulevard. Stop in. We have coffee and an occasional donut or two. So happy to share one with you. And without further ado, we are at Pharus Global Live at 5, episode number 41, talking about reverse mortgages, get the facts. And our special guest today, Frank Lillo.
Hey, I'm here. You
Welcome,
were going through that
Frank.
whole list before. I was going to say, we do anything for money, I guess.
That's it. That's it. We even have some fish and fish tanks here in the office, actually. So come on by. But Frankie, third time is a charm. We've missed you. It's been a while.
I'm going to have a talk with my manager because he hasn't got me back on the show in 13 months. That's no good. That's no good.
Yeah, we got to get you a new promo manager out there, huh?
New booking agent.
New booking agent. That's right. That's right. So, president of Pharus Home Mortgage. So, tell us, how are things going in Pharus Home Mortgage land, and what's new and exciting over here?
Well, you mentioned a bunch of stuff a moment ago. I'm not going to be redundant and go through it all again, but I think that if people were listening and heard all those things that we talk about, what's really important to take away from that is the fact that we have a really great value proposition for our clients, because if you've got somebody who needs one or more of those services that we provide, once they've gotten to work with one of our reps in one of our companies, maybe they're buying a house and they're working with one of our Crestcore agents, and then of course they need a mortgage or they need insurance, it's pretty probable that they're going to feel comfortable staying within the family, as it were, if the first person they dealt with they trusted and felt good about. So that's a good thing for people. I mean, we're used to this business, so we deal with the craziness all the time. But for many people, buying a house for the first time, or first time in 20 years or whatever, or buying a business for the first time, it can be pretty intimidating. And you really want to know that you've got somebody watching your back. And I think that's what we offer, in addition to all the services, is that environment that you can feel confident in what you're dealing with. So from the client's perspective, that's that. But then again, the other thing we have is for our employees that work at any of our companies, we have a great value proposition for them, right? So if you've got a real estate license and a mortgage loan officer license, you could legally do referrals and earn commissions from those activities. So if you're helping somebody buy a home, you can also do the loan for them, the mortgage, if you do the right disclosures, if it's not an FHA, but whatever's legal, we will do. So that's usually pretty nice. And then if you happen to have an insurance license as well, now you got all three of those going for you. But all the rest of our companies, you don't even need a license. So if you wanted to earn some referrals or commissions on commercial financing, right? Your bailiwick, Pharus Funding, they have the opportunity of learning how to actually originate a commercial mortgage, or just referring it to one of your team members and making a pretty nice little referral commission for that. The credit repair and credit building activities, no licensing required there. So, long story longer, but anybody who is interested in exploring that, that's an important value that we bring to the table. So that's what that is. So, and just to finish my little commercial, as it were, I mean, we're basically growing and hiring people. We're looking for seasoned loan officers and realtors that want to jump in and be part of this exciting growth environment. We'll have to see. The last few weeks maybe haven't been as exciting as things are starting to shift out in the world, but it all what goes around comes around. So we'll be there doing our thing. So we'll be opening branches and looking for growth from within, because I'm sure looking to retire and take a nap. So there's opportunities all around.
You want to retire at 25, huh?
I just turned 26. You missed my birthday.
Darn it. So Frank, I love the whole ecosystem. You coined the phrase, and it's been awesome to be able to describe that. Tell us what Pharus Home Mortgage. What makes Pharus Home Mortgage different than just walking into your local bank for a loan?
Well, I'd like to think a couple of things. First of all, and necessarily so, we have mortgage loan products for just about every situation. Now, that doesn't mean that our borrower is going to like the option that we provide, but our job is consultative. And I think that's what's exciting about us is, there are places people could jump on the phone and what's the rate today? And they'll quote them a rate and bingo, bango, hey, send me this, I get the proof. That's not us. So if that's what you want, don't call us. But if you want to contact a company that's going to understand your goals and objectives and your financial profile, take the time to listen and go through and develop options that are available to you, because most people can qualify for more than one type of loan. And then we will present them with the information that says, if you get this type of loan, it's going to be these terms, these 30-year and this rate and that kind of thing. And here's what your monthly payment will be. If you get this type of loan, it's going to be a little different. So then they have an opportunity to make an informed decision. I know I come out of the software sales world. I used to sell $1 million software systems to manufacturing companies. And that's what we did. And I just took that same model here, is we listen, we understand, we present all the options, and you make the final decision. So I think that's great.
So I think it holds true similarly to us on the commercial side, that by being able to give them options, you're not just trying to fit them into a box.
Exactly. And now if you go to a bank, they're going to have fewer options. So by definition, it's harder for them to provide that level of service.
Yeah.
And just so everybody knows, we're going to be talking about some myths today, and but there's a myth in the mortgage world, and that is some people think that a mortgage brokerage you go to when you have bad credit or you have problems and you can't go to the bank. But that's really not true. We have, for those people with the high credit scores and the appropriate scenarios, we're just as competitive, if not more so, with the banks. We deal with the wholesale divisions of many of the major banks. And so you get all the other good things that come with our ecosystem, as well as the same scenario that you would get at the bank.
And I think the other myth is that it's more expensive to work with a mortgage brokerage company, right?
That's true. That's true. And again, that's not true. And what's really kind of good, if I could take that, expand that example a little bit more, is we have the option of being able to provide a flexible scenario to make sure we can meet everybody's needs. I think the bank may not be quite as flexible. That loan officer sitting at a desk probably doesn't have the decision-making ability or capability or authorization, I should say, to take some steps to get things done for people. So it's a fun environment, and we always encourage people, go ahead and get a quote or get a proposal from somebody else, from your bank or whatever. We have no problem with comparing. We may not always be the lowest interest rate, but the lowest interest rate is not always the most important goal. So again, that's all part of that discussion.
That's awesome. So that helps potential clients. And if anybody's interested in employment, what's the best thing that they can do?
Well, I would encourage them. You got on the bottom of the screen there. Call that number 925-8202, or you can email me Frank at FarrisHomeMortgage.com. Stop by and see us at 1859 Southeast Port St. Lucie Boulevard at Pharus Global Plaza. We're on the 77th floor, and we'll chat.
That's awesome. And Frank, before we go on, let me just mention to everybody who's watching out there in TV land, um, if you would like to ask any questions, drop them into the comment, whether you're on Facebook or LinkedIn or YouTube, and we'll be happy to answer them as they come in. Even if you just want to say hello, drop a hello in the comment section, and we will be happy to acknowledge you. So Frank, appreciate the background and I love the idea of beating the myths. I think that's a great way to move forward. We're going to be talking about something that I think people have a lot of myths, like you mentioned, and a lot of misunderstanding about. And so I'm excited to hear more about it. That's the topic of reverse mortgages, and it's time for them to get the facts, right, Frank?
Absolutely. Absolutely. I just mentioned a moment ago that we pride ourselves on being consultative. So if I'm dealing with a couple that can qualify for a conventional loan, for instance, but they might also qualify for a reverse mortgage, I want to give them those options. And sometimes I'll make that comment. I'll mention reverse mortgage to them, and they'll say, no, we don't want the reverse mortgage, no. But unfortunately, they're really kind of reacting to some old historical experiences that are no longer the case. So a lot of things changed back in 2010 with rules and regulations. So it's a whole different type of product and really deserves to be looked at as part of your overall strategy and options. And that's what I'm hoping to be able to present today, is to take away some of those myths so people are not afraid to even just talk about it,
I think one big misunderstanding that I've heard out there is that it can only be used to refinance a mortgage, that it can't be used to purchase.
You hold that thought, young man. That's on page 7 of my notes.
And the other thing that I hear a lot out there, and I'm sure we'll get into this too, is I'm going to lose my house.
Yep. That's the first thing I hear from many people, is the bank's going to take ownership of the house. And the answer is they're not. And, and not only they're not, but we're going to put that in writing, Fortunately or unfortunately, the mortgage world, especially reverse mortgages, are heavily regulated to protect seniors, right? So when we provide you with a proposal, you're going to get 70 pages of boilerplate and legal descriptions and caveats and blah, 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 which is great. There's really only a couple of pages in the whole 70 that have numbers and kind of really need to be looked at. But the government is working hard to make sure that seniors get as much information as possible. So when we tell you something, it'll be in writing. And if you don't get something in writing from whoever you're dealing with on mortgages or pretty much anything else in life, then you've made a big mistake. So that's important. But let me do this. So before we talk about some of the myths, I just want to talk about the very first question that comes up a lot of times, and that is, I'll mention it to somebody about a reverse mortgage, and their answer is, well, we really don't need that. We've got money. We're doing okay. We don't. And I came up with some scenarios, and if I may, just to keep, to a little food for thought for people out there, right? So let's look at first scenario. You got a senior couple, age 62 or older. They have to be 62 or older to get a reverse. And by the way, I'm using the term reverse mortgage, but the official term is a home equity conversion mortgage, HECM or HECM, which sounds like I'm about to throw up or something. But anyway, so I might use the term HECM, same as a reverse mortgage. So you're a senior couple, you're living on Social Security, you have no retirement accounts, no retirement income, no savings account, just cash flow from Social Security. So cash flow is tight. especially nowadays, right? As the gas prices go up.
Yeah.
So obviously, excuse me, obviously they have a need. And if they've got 60% or more equity in their home, then they're sitting on a pot of gold, basically. They're sitting on money that they can use to live. So, a HECM can really provide them with some much needed cash by drawing on that equity in the home and using it to do what they need to do, paying bills, maybe medical bills, maybe they need to do some work on the house, etc. So they'll still have money or equity left over for their legacy, for their heirs, and we're going to talk more about that. But you know what? Maybe they deserve. I've had a couple of couples over the past year or so say to me, "Hey, my kids are okay. They don't need my money. We're going to take care of ourselves." So that's the thing. You've got to have your quality of life first before you think about that. But there will be equity left over. Because you really can't borrow more than about 50% of your equity. It goes up with age. The older you are, the more you can borrow. So, but it never goes higher than about 57%. So you've always got over 40% equity in that home as time goes on.
And I guess that's designed specifically to be in the client's best interest.
Exactly. Now, a reverse mortgage is an FHA insured mortgage. Everybody's heard of FHA mortgages, that you use a traditional mortgage to buy a house, and they have a lot of stipulations and so forth, and they're very helpful for people. This is an FHA insured mortgage as well. So that's one of the many things that are in place to protect seniors from getting into trouble. And there's other things as well. Here's an example. I'll just jump ahead for a second. But if you have $100,000 equity in your home, if that's how much you qualify for based on your age, they won't give you the whole $100,000 up front, even if you ask for it. You can only get, in that example, about $25,000 at closing the first year, and then you have to wait a year before you can get the rest. So again, trying to make sure people are not being impulsive. In the old days, there were less than scrupulous mortgage people that would encourage people to take out all the equity from their home and buy annuities and buy investment products. Of course, those then they lost money and they lost all their money. So those things can't happen nowadays. So here's another example. Scenario number 2. You've got a senior couple and they've got a big fat 401k or a stock account, right? A lot of money in it. And they've got 60% of equity in their home. So somebody might ask, well, they have a big 401k account and stocks. Why would they need a HECM? And the answer is they don't necessarily need it, but a good financial planner, and many of them hopefully are listening and will be familiar with this term. If you're in retirement age and you're drawing money from your 401k or from your tax qualified account, right? Then when you take that money out, it's gone. So if right now the stock market is not doing too well, it's dropped by 2,000 or 3,000 points. So if you're drawing money out of the stock market or out of the 401k today, you've got a real loss, because you're not losing money if you don't touch it, right? It's like when the house values went down back in 2008 for several years. A lot of people were upside down. But if you didn't sell your house or lose your house, you didn't lose money. And then they've all come back and then some, right? They've all grown higher. So that's the key. You want to not take money out when they're low, right? You want to buy low and sell high, as they say. So what you do is they call it sequencing. If you can time the withdrawals from a 401k and or some other type of a savings account and or from your home equity line of credit, which is your HECM, right? You take the money from the HECM at those times when the market is down. And then if you want to later on when the market's way up, if you want to take money again from your 401k, you can actually pay back against your HECM line of credit if you want to. You're not required to, but if you do, now you start balancing, right? So now you've improved the line of credit again by paying some of it back, and you're taking money out when stocks were higher. And you can save over time. I mean, I've seen examples of over a 20-year timeline where you really maximize asset value and income stream by doing that. So even if you've got a bunch of money in the 401k, you still, because of the realities of the world and the stock market, you really want to look at having a line of credit. We call it a line of equity, but it's kind of like a line of credit, and be able to use it that way. And again, I'll jump ahead for a minute here, but just why it's so important. If you have $100,000 line of equity and you didn't take it out, in other words, you qualified for the HECM mortgage, you went to the closing table, but you didn't take the money. You left the equity there, right?
Mm-hmm.
As long as it's in there, you're earning guaranteed interest. So it's going to grow until you take it out, right? So even that adds to the whole sequencing advantages there, which is really kind of cool.
I don't think a lot of people are aware of that, Frank.
Most people are not. Most people are not.
Huge benefit. So
yeah.
So basically, what you're saying is you can get people approved for the home equity conversion mortgage,
mm-hmm.
and they can actually use it. Yeah, HECM, and they can actually use it as if it were like a home equity line of credit, similar to a home equity line of credit, where they can pull it out if and when they need it, but not necessarily do they have to.
And they can pay it back if and when they want to, but they don't have to. And as long as the balance is out there, whatever balance they haven't drawn out, as I said, is earning guaranteed tax-free interest, because it's not real interest like you're earning on money, which is taxable. It's equity interest, so the equity is growing, but there's no tax event there.
And at no time do they have a monthly payment on it.
Yeah, there's no monthly payment on a HECM mortgage. The principal and interest you don't pay the principal and interest. However, you always have to pay your property taxes and your homeowner's insurance, just like with any other mortgage. If you take out a regular conventional mortgage and you stop paying your homeowner's insurance, foreclosure. So, I mean, it's the same thing.
But the difference between a home equity line then and a HECM is it's available when you need it, just like a home equity line, but you can draw it and you don't have to make a payment monthly compared to a home equity line of credit where you would have to make.
Exactly.
Huge benefit.
It is. Let me give you one more scenario. Scenario number 3. Let's say you've got a senior couple again and they have an annuity, and that annuity pays them enough money each month for the rest of their lives to meet all their daily cash flow needs and a little left over for fun or whatever, right? And they've got a home with at least 60% of equity. So somebody would say, well, they certainly don't need a HECM, right? But even though that might be correct from one perspective, if they had the HECM line of equity, like we've been talking about, then they may want to use that money to go buy a second home in the Keys or a vacation home in Alaska, or use that money to help their grandkids or to buy an investment property, increase their cash flow, and have even more legacy assets and money to leave to their heirs. So again, it's a tool. It's a tool to help you in those scenarios, and there are other ones, but those are 3 kind of common ones right there. So when people hear about reverse mortgages, they should at least understand it's just another FHA insured product available for an option, for a tool based on your goals and objectives. If your goal and objective is to have no money taken out of the house, and you want to have the maximum equity available at the end when you pass, that's an option. So you don't need a HECM. A lot of people have other reasons why they would want to use one, and it's a safe and viable product.
That's amazing. So I know we talked about basically the benefits of a HECM. Let's switch gears. We talked a little bit about myths also, but why would someone hesitate to get a HECM?
Well, that's a great question, and it's kind of I've run across cases where I was working with a couple and they qualified for a HECM and they really needed a HECM. They really had a scenario that made a lot of sense for them from a financial perspective to have a HECM. But because I couldn't get past the misinformation and the myths, and I never force anybody, I don't push it. My goal is to give you information. If you want to believe it or not, that's up to you. like I said, we give it to you in writing. So it's hard to believe. But here's why. There are several myths out there. The first one is they're going to take my house. The lender won't take your house. You have title, and there's a lien on the title, just like there is with any other mortgage, right? So you own the home. It's a lien state. Florida, they have a lien on your home. And as long as you're paying your mortgage, they can't take your home. Another one is that some people think that your house has to be free and clear, no mortgage on it, in order to get a reverse mortgage. And that's not true either. Many times we've done reverse mortgages where the reverse mortgage pays off the existing traditional or forward mortgage, get rid of that mortgage payment, and there may or may not even be money left over for all the other good stuff. So that's myth number 2. Another myth is that once you get the money from the HECM, the reverse mortgage, that you have to pay taxes on it, like income taxes. And you don't, because it's not income, it's not money, it's equity, right? So whatever money you're taking out of your home is tax-free. Another myth is people think that there are restrictions on how you can use the money. And the answer is there are no restrictions. You can use that money for anything that you want. Now, you're going to have plenty of people advising you. One of the steps you have to go through to get a reverse, the very first step, if you say, Frank, we want a reverse mortgage, and I've checked your numbers and you qualify, before we can even do an application, you have to go to counseling. And counseling is a third-party, HUD authorized, approved counselor. We can't talk to them. They have nothing to do with us. They have nothing to do with the lender. They're all they're put in place by HUD. And that's about an hour to an hour and a half phone call. It used to be an on-site visit before COVID. And those counselors will tell you, don't do this and don't do that. Again, so there's plenty of opportunity to hear the facts and the truth and be admonished accordingly so you can make a decision. But they'll tell you, that you can use the money for anything they want.
I'm sure they're not going to advise you to go to Vegas and put it on Black 13, right?
They probably won't advise that, but you can do that. You can do that. And some other things that the audience ought to know is that the HECMs have a lot of consumer protection in them. Again, they're operated by FHA, insured reverse mortgages. So all of the lenders, all the mortgage brokers that deal with these products have to work within the same guidelines, and there's no wiggle room there. And that's great. That's great. The other thing is that we really encourage that you meet with somebody that you trust. And we hope that's us, right? Because early on, we talked about the advantage we have of our environment, where you've gained some confidence in our ecosystem representatives, of people in our organizations, and you trust them. But I'll take that a step further. One of the first questions I ask people when I'm filling out the initial spreadsheet before doing an actual application is, are your children involved in this decision? Or can they be involved in this decision? I would love it if the adult children are always involved from the very beginning and through the whole process, for a couple of reasons. One of them, because it's important that they understand what's happening so they can continue to guide their senior parents through the process. The other one, I'm a little selfish because I know that if they are involved, they're going to see how well and professionally we handle it and the benefits of the reverse mortgage, as we've talked about, and they're going to tell their friends, hey, you got to go see these guys so they can take care of your parents. So it's kind of a couple of extra things there. But I love that. I love that when I'm dealing with when they bring it. Now, some of these people tell me, I don't want my kids involved with this. There's none of their business. So that's fine too, whatever. But we always encourage it.
There's a question coming in, Frank, from John Frange. He says, most people compare interest rates when they're looking for a mortgage. Is there such a thing as comparing rates or something along those lines with a HECM?
Great question, and the answer is absolutely. So think of it this way. A forward mortgage, a traditional mortgage, they're going to give you an amortization schedule as part of your paperwork before you even sign. And that amortization schedule is going to show you make this payment, here's your principal balance, and after about 200 years, the principal balance comes down to zero, right? So you could see it amortizing, and it does that The lower the rate, of course, the better, because then you have less interest and more to apply against principal. We also provide an amortization schedule to our clients for a reverse mortgage, but the difference is it's not amortizing because there's no payment, there's no required payment against the principal. So what happens is the principal balance is actually going up, as you can imagine, over time, because you're not paying against it, or you don't have to pay against it. But yes, so again, the rate comes into play. And we have rate sheets, and we deal with rates the same way we do with traditional mortgages. What a lot of people don't know about the mortgage world, when they call up and say, "Hey, what's your rate today?" There is no rate. If I took any scenario, a 30-year conventional mortgage for somebody with an 800 credit score and 20% down and blah, 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 when I go to that lender's website for that scenario, there's going to be about 20 rates. What? That's right, 20 rates. And here's what they mean. So those rates on the rate sheet represent various investors that are willing to buy those on the secondary market, right? So if the rate of 4% has a zero cost, then that's what we would call a par rate. But there could be a rate of 3.5 that has discount points of $2,000. So now somebody can say, I can cost justify paying $2,000 to get that rate, the 3.5, because my delta, my savings in the P&I over the time period that I expect to be in the home is going to pay it back. And it's usually a 4 or 5 year period. Every time I've tried it, it always turns out to be 4 or 5 years. So if you're taking out a loan and you're guaranteed to be in that house for at least 4 or 5 years, you could consider paying some discount points. But it also works the other way around. Because you may be well qualified for this loan, but you're kind of short on cash to close. Another couple of grand would help. You could actually pick a rate higher than the par. Instead of that 4, you might pick 4.5. And now you're going to get a credit back from the lender of a couple of $1,000, right? So you pick the rates as they match your requirements and your scenario. And we explain that all to people when we're monitoring rates with people. We send out an email with all the rates. We even show them the lowest rate. The lowest rate may be it used to be a lot lower now, but let's say it's a 3, it might cost $7,000 discount points to get the 3. But you've been informed. And we actually had one person who was willing to pay that kind of money because it made sense. It's a cost justification business decision. I'm going to be in this loan for 10 years. I'm going to pay back that money in 5 years, and then I'm way ahead of the game starting in year 6, right? So the interest and the same scenario applies to the reverse mortgage, which was the question that I got away from, but I'm coming back to it. So yes, there's a rate, and right now, if I just did a reverse mortgage, it's a fixed. There's 2 types, fixed and adjustable, and the rate was 3.56, which is tremendous nowadays. As if anybody who's been watching. Because the 30-year rate used to be hovering around 3 just a few weeks ago. It's now hovering around 4. So the rates are competitive, and you should be attentive to the rates, because when we're quoting proposals, we can give you a proposal based on different rates, and the different rates obviously will impact the principal non-amortization, but they also impact the amount of money that you can get out at closing. So it's a very valid question.
Awesome.
So a couple of more things that hopefully I answered the gentleman's question. A couple more things that you should know about. Drawing funds, right? An adjustable rate mortgage is the most flexible reverse mortgage because you can take money out at closing and then you can take money out again after the first year. My example before $100,000, right? So let's say at closing I got $25,000 to do whatever I wanted with. I still have a $75,000 line of equity, like we talked about, and it's earning guaranteed interest for the first year. At the end of that first year, I have several options. I can say, I don't need the money, let it stay, and it'll continue growing. That's a guaranteed rate. The same rate that they use for the amortization or non-negative amortization, that same rate is also applied to the growth of the equity, right? So that's one option. Just leave it there. I don't need it right now, knowing that if I need it on a moment's notice, I can write a check, right? Or you might say, I think I'm going to take a monthly amount out. Why don't you send me $500 a month? And you'll get $500 a month until the money runs out, the line of equity runs out. It could be 2 years, 5 years, 30 years, whatever it is, right? Or you could say, I want you to annuitize my money. Take the chunk I've got left and figure out how much you can guarantee to send me every month until I die. So it's annuitized, right? That's another option. And you can mix and match. Give me $500 a month for the first year, and then annuitize the back, whatever. Just you can mix and match all those options. And again, we review those with our clients to see how they match their real world, real life needs at the time. Let's see. So we mentioned no mortgage payments, and all of the brochures and proposals and documentation is very diligent about reminding people, yes, there's no mortgage payment, but that's just the principal and interest that you're not paying. You always have to pay your taxes and your homeowner's insurance. If you've got an HOA or a condo fee, you're going to pay that just like with any other mortgage. Mm-hmm. One last thing I want to mention before we move on is that many times a senior couple cannot qualify for a traditional mortgage, okay? Because we have to use their income and their debt and calculate ratios. And unfortunately, the ratios are too high because the income is not enough to cover the spread. But the reverse mortgages are not based on ratios. They're based on what they call residual income. So we take your income minus your property expenses, minus your credit cards, etc., and we look at how much money you have left over in a month. And then depending on the number of people in the household, 1, 2, 3, 4, etc., there has to be your leftover, your residual has to be higher than that amount. And if it is, you qualify. It's not based on credit score, although credit events are factored in, but we've gotten reverse mortgages for people with bankruptcies and foreclosures and all that stuff. So it's definitely factored in. So it's easier to get a reverse mortgage many times than a traditional mortgage, which is good for seniors because a lot of them are just living on Social Security, and even if they wanted to make a mortgage payment, they may not have the opportunity to.
I don't know if you would know the answer, Frank, but since the inception of reverse mortgages, has the age requirement gone up or down?
To my knowledge, it's been 62 since the beginning, but I can't say that I'm not 100% sure of that, but I've never heard of any other age bracket than that in the years I've been doing this. So
I was just curious because you hear about 55 plus communities and 55 to get senior discounts. Mm-hmm. So I think it would only be fair if they let people get reverse mortgages that are 55.
You know what I hate? I hate when I go in for coffee and the girl at the desk gives me the senior discount. You didn't even ask for my ID. Just assumed I was an old man, but that's okay. I digress.
Well, I think we covered a lot of ground, Frank. At this point, was there anything else that you'd like to mention before we close?
Absolutely. And you touched on this in the beginning of our discussion, and that is that many people, for all you realtors listening out there, many people don't know that you can buy a home using a reverse mortgage. And how does that work? It's very simple. I've done many of them. You write the contract the same way. Nothing changes except the buyer, the 62-year-old qualified buyer for a HECM mortgage, puts down about 50%. Could be 51 or 52. Could be 49, depending on their age. But let's say 50%. And then we go to closing. And now they have a reverse mortgage with all the things we talked about. Now, the difference there is, of course, if you buy a house with a reverse mortgage, you're not going to have a line of equity to draw from and all that stuff unless you put it up front. In other words, if the requirement was a 51% down payment and you put in 70%, then you'd have that money in there. But I haven't seen people do that. But I do have, on the subject of buying homes, again, for the realtors that may be listening, why do you care? Well, let me tell you why I think you might care. Here's a couple of examples. I always like to pick on New York, right? So you got a senior couple. They just sold their large tenement house in Brooklyn. $600,000 cash in the pocket. They've been living there for 40 years. There's no mortgage on it, so they got a lot of bucks. So they come to Florida Now they want to buy a house. So let's say they have $600,000 cash. One option they have is what? Buy a house for 550 grand, have money to pay the closing costs and a few bucks left over, and they got a house. That's one option. Or maybe they'd like to buy a more expensive home. Maybe they see a beautiful home on the water in Sewell's Point or whatever, right? They want to spend $1 million. They can do it. Why? Because they can put down 500,000 out of their 600,000 cash, buy $1 million house, still have 100 grand, give or take, left over after closing costs, and no mortgage payment, right? So now, Mr. Realtor, you're selling them a much higher, a more expensive house, little bigger commission check. Everybody's happy, right? Or they can actually, as I mentioned, if they were buying that house, if they put up, say, if they needed $400,000 to buy an $750,000 house, they could do that. They could put up $500,000, and that extra $100,000 will go into their line of equity and all the great things that we talked about with that. So lots of options here as well.
Very interesting. So purchases, refis, you could use it, you could pay it back, you could use it again. These are all things that I think a lot of people were unaware of, possibly. So great information, Frank. We appreciate that.
I'm glad to get the word out, because we don't, we, as I mentioned earlier, we've got mortgages for everybody, every situation. You may not like the rate. If you're buying investment properties, the rates may be 5%, 6%, 7%, depending on the scenario. But if the numbers work, they work. So we've got all those loans. We have special expertise with reverse mortgages, but that's not all we do, and we don't push it. As I said, our goal is to present options. And if we present that option and they don't want to talk about it, that's the end of the story. But they'll get all this information in writing, and they'll know that it's for real if they really want to.
Awesome. Awesome information.
So what I would encourage anybody to do for reverse mortgages or traditional mortgages, we've got online apps that you can go put in your information, or you can call us, and one of the loan officers will take your information and we'll put together a scenario. We don't even have to run your credit report up front. We'll take what you tell us, we'll put in your numbers, we'll give you an initial pre-qualification. I'm going to get on the soapbox for a minute here, but we'll give you a pre-qualification that says, if all these numbers are true, this is what you qualify for. So let's compare them, right? Same with the reverse mortgage, we can compare them all. But again, for all you realtors out there and for all you sellers out there, there's two types of things: there's the pre-qualification and the pre-approval, and that they're defined differently depending on who you're talking to. But at Pharus Home Mortgage, we don't give a pre-approval letter unless we've actually had it underwritten by an underwriter at a lender. And we have many of our lenders that will allow us to submit a loan prior to having a purchase contract, prior to having an address, and they'll actually underwrite the loan and they'll approve it pending, contingent on whatever the property ends up being. It has to appraise and so forth. That's when you get a pre-approval letter from Pharus Home Mortgage. Otherwise, we'll give you a pre-qualification letter, but we won't even do that until we've run your credit and made sure that the numbers are documentable. So there are some mortgage people around town. I know I keep bumping into them as I go day to day, and they'll issue pre-qual letters. If you can breathe, you got a pre-qual letter, because it's really not a legal document. It doesn't really, it's got all the caveats at the end. This is not a commitment to lend. We're not a lender, blah, blah, blah. But I want our realtors to know that when you get a pre-qual letter from Pharus Home Mortgage, it means something. And if you get a pre-approval letter from us, it means a lot. So that's the end of my soapbox.
No, I think that's really good information. So all the realtors out there that are sitting around and waiting, give Frank a call. You got the information right there. Baby boomers, same thing. Kids of baby boomers, get the information out to your parents, because unfortunately, the thing that comes to my mind is the senior couple that can't really afford to live on a day-to-day basis, and they have a ton of equity in their home and don't even know that this is available to be able to have funds and not necessarily have to make monthly payments on it.
Absolutely. And, I had somebody not too long ago having a discussion about this. It was a senior woman, and we were talking about these things. And she said, you know, I'm a little hesitant. I don't know. I said, look, here's my question. If you had a bag of gold sitting in your closet in the bedroom, and you're living your life and you're having trouble paying your bills, or you really need a vacation but you can't afford it, blah, 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 would you hesitate to go to the closet, take out some of the gold, cash it in, and go do some stuff? She said, no, absolutely. Well, it's the same as the equity in your home. Why not? Why not take it? I mean, if you're worried about leaving stuff for your kids, that's fine, but balance your own needs and requirements and desires and make the appropriate decisions.
Absolutely. Awesome information as always, Frank. We appreciate it. You want to take us home with a particular song, Mr. Singing Mortgage Guy?
We're in the money.
We're
in the money. Get a reverse mortgage from Pharus Home Mortgage.
That's awesome. And a quick thanks, Carla Wooten. And she liked our show. Christina Miller, that is my girlfriend. Got to send out the love to her. She loved our show. Thank you, everybody that watched tonight. We'd love to have you, if you're interested of being on the show and want to get information out about your business, you could reach us at pharusglobal.com. All of our contact information is there. Frank is waiting at his phone right now for people to be calling. Where is it? There it is.
Waiting. Here it is.
Here it ring. You got all of Frank's information there. Give him a ring. Get the information that you deserve. Frank, thank you very much for being on. Appreciate it.
Thank you for having me. It was a great opportunity to get the word out. I appreciate it. It was a lot of fun. And don't make me wait another 13 months before I can get back on.
You're darn right. I'm going to be coming after you.
All right.
Have a good night, everybody. Thank you, Frank.
See ya.